Welcome back. We are kicking off the week of December 1st, 2025. And the market is flashing a major paradox.
A huge one. It's really pulling in two different directions.
Exactly. On one hand, you have the S&P 500 hovering near all-time highs, up at 6,849.
Right. And at the same time, the VIX, the fear gauge, it just got crushed.
Crushed. Down from 28 to 16. It screams complacency. But then you look at the other side of the coin, and it's just chaos.
Complete chaos. Bitcoin crashing below $88,000, liquidating, $646 million in longs?
And gold is surging past $4,200. So what is going on here?
Well, this extreme divergence, it's critical. It tells us we're at a really significant inflection point.
An inflection point.
Yeah. Capital is flowing out of those high-risk speculative assets, and it's rushing into very specific infrastructure plays. Our mission today is to cut through that noise and, find the single biggest bottleneck that smart money is loading up on right now.
Okay, let's start with that S&P strength then. The technicals look pretty strong. I saw the S&P closed above all three key moving averages on the weekly chart.
First time since October. But the real story, the most powerful signal, was the speed of the breadth thrust.
The speed.
Yeah, the speed is the key insight. When we talk about a breadth thrust, we mean how fast market participation ramps up.
So how many stocks are joining the party?
Precisely. And in this case, the percentage of stocks above their 50-day moving average jumped over 50% in just 5 days. That's faster than the April rally. That's conviction.
And you're seeing this in the institutional data.
Oh, absolutely. The dark pool data showed institutions sweeping $3.2 billion into equities right at that 6,650 support level.
So that's the smart money.
That's smart money buying facts while, dumb money is selling fear.
Okay, so that brings us to the big thesis shift.
Yeah.
For, 2 years now, the AI trade has been all about chips, GPUs, semiconductors.
It was, but that's changing.
Why is it changing?
Well, you're seeing margin pressure on leaders like NVIDIA, and you've got big customers like Google and Meta developing their own chip alternatives. So the bottleneck is moving. It's shifting downstream.
And the new bottleneck isn't processing power.
It's electrical power. The demand from data centers is it's staggering. We have 80 gigawatts of capacity planned in the pipeline.
80 gigawatts.
But the current transmission infrastructure, the grid, can take up to a decade to build out.
A decade. So there's a huge mismatch.
A massive one. And the financial flows are screaming this. BlackRock's Bitcoin ETF saw $2.8 billion in redemptions, while energy infrastructure funds just hit 3-month highs. The immediate play isn't waiting 10 years for the grid, it's on-site power generation.
Before we get to the specific plays, let's mark out the battle lines. For the S&P, you mentioned that support is critical at the 6,700 to 650 zone. We keep hearing that described as a put wall. What does that actually mean for listeners?
So it means huge options contracts, specifically put options, are concentrated right there. If the market drops to that level, the market makers who sold those puts, they're forced to buy the underlying index futures to hedge themselves.
So it creates its own floor of buying pressure.
Exactly. It's a massive structural support mechanism. That level must hold. Meanwhile, Bitcoin has confirmed a death cross. And you've got $6.2 billion in long exposure sitting dangerously in that $83,000 to $85,000 range.
Okay, so that raises a question about the new bottleneck. If the problem is grid power, why are we looking at a company like Supermicrocomputer, SMCI, which is a server provider? Isn't that still a step removed from the actual generation problem?
That's the nuance, right. SMCI specializes in these high-efficiency, liquid-cooled, density-optimized AI servers. They directly address the on-site power and cooling problems.
So they're the immediate solution.
They're the immediate solution while the grid catches up. And it's an AI server play that's trading at, get this, 0.9 times price to sales.
Less than 1-time sales.
With a $39.2 billion backlog. It is wildly undervalued compared to historical multiples.
Okay, and what about a pure electrical infrastructure play?
That would be Quanta Services, ticker PWR. They are the dedicated electrical bottleneck solution. They have their own massive backlog, also $39.2 billion. But theirs is driven by building the transmission lines and distribution hookups for these data centers.
And the growth is there.
18% accelerating revenue growth tied directly to this infrastructure strain.
So the trigger for all of this, the thing to watch, is this Friday, we've got a big data cluster coming.
That's the final boss, personal income, personal outlays, and the big one, core PCE.
And how do we play that?
It's simple. If we see weak jobs data, The odds of a Fed cut spike, gold rallies, and tech gets a boost. But if that data comes in hot, yields are going to spike, and speculative assets like Bitcoin could get crushed.
So until then, all eyes are on that 6,700 level. If we hold it, we get a Santa rally.
And if we break it, we enter Grinch mode. The core principle is always the same. Don't predict, just prepare.
This episode is powered by Kaka, your trading sidekick with more questions about why Bitcoin whales accumulated 83Ks than a no-coiner at a Miami crypto conference. Don't forget stockkapaka.my.canva.site, where the only thing more undervalued than SMCI at 1x sales is your portfolio if you ignore the power bottleneck. This weekly market navigator analysis is for educational and informational purposes only and should not be considered financial advice.